Okay, good morning, everybody, and happy spring. Thanks again for participating in our Q1 2022 webcast. Today we put together an agenda. Once again, we're going to focus on about 30 minutes for today. If there's any follow-up, go ahead, send us questions. We'll have to address them, and we'll be looking forward to scheduling kind of the 1Q review for those of you that we've not already met. So this is our agenda today. Once again, Nick and Matt are going to go through the 1Q market review. We're going to talk about our global outlook and portfolio positioning. And then today, given there's so much dialogue about inflation and interest rates, we're going to make a special section on that. Obviously, it's a topic, it's in the news. Many of you have asked questions about it. So we're going to have a focus session on that. So with that, I'm going to turn it over to Nick.
Great, thank you, Kurt. Hello, everybody. We're introducing a new visual here. We think this is a better way to display and discuss our proprietary model signals and the performance impact of those signals. So each line in this table below is an analysis of a relationship between two asset classes. So I'll kind of go through this line by line and kind of use my mouse to kind of help show where I am. So each line here, as I said, compares two relationships. So this first line here, we have fixed income relative to equities. You'll see across the top here, this is the signal strength. Wherever this circle is, if it's closer to the left or the right, it favors that asset class. So between fixed income and equities, right, the model's neutral. We're going to go through that chart later on in the presentation. So that's why this circle's here in the middle. We look at the next decision between public markets and private markets. As you all know, we've made a big shift to private markets here over the last kind of 15 to 18 months. That's signified here by an overweight to private markets. You see private markets highlighted in blue means that's where we're tilted in client portfolios. So how did that decision work for the quarter? That's here in this last column. So a mix of the 6 semi-liquid private market investments outperformed just being in a pure core fixed income global equity portfolio by about 7.7% for the quarter. Significant outperformance. And that's already on top of outperformance that we saw in 2021. Getting a little more granular, when we look within fixed income, we have a short duration tilt in the portfolio relative to kind of a intermediate or long duration tilt in the portfolio. Short duration outperformed kind of intermediate duration by about 2.4% for the quarter. So that decision was correct as well. We also compare government bonds to corporate credit bonds. We don't really have a signal there, so we're neutral to that decision. And then within opportunistic bonds, we were invested in high yield coming out of COVID. We've kind of shied away from that decision, selling down those positions in favor of floating rate high yield bonds, which have less interest rate sensitivity. This decision also worked over the quarter as floating rate bonds outperformed traditional high yield bonds by about 4%. Digging into equities, the highest level decision is whether we want to be in US or non-US equities. We have a modest small tilt to non-US equities in the portfolio. We have some slides later in the presentation that will go through that decision. That was pretty much a non-event for the quarter. Non-US stocks underperformed US stocks by about 10 basis points. So pretty much a non-event. Large cap and small cap were neutral weighted in the US. And then within the US, we have a value overweight relative to US growth stocks. This was also a significant contributor to outperformance during the quarter as value outperformed growth by over 8 percentage points for the quarter. Developed and emerging stocks, neutral signal, no tilts there in the portfolio. And then as we discussed last quarter, we are now using Innovator's defined outcome ETFs. These provide us an opportunity to participate in market returns on the upside while protecting us against some of those downsides that could happen from excess market volatility, geopolitical events, Fed action, over the next 12 months. So we have a modest tilt there as we're starting to add those to client accounts. During the quarter, a basket of hedged equity ETFs outperformed an unhedged basket by about 2.8%. So of these decisions, 5 out of the 6 added value, 1 was relatively neutral. Looking at the next page, looking at the macro environment summary, as we reflect on the first quarter. So on the macro side, the 2 largest drivers of performance during the quarter were 1, the Federal Reserve raising the Fed's fund rate, which started the unwind of accommodative policy that started during COVID. and two, the tragic event of Russia invading Ukraine. From a market perspective, the Russia-Ukraine impact on the market has mostly faded for now, while the Federal Reserve path to neutral is the largest driver of market returns. Higher inflation continues to persist, but we're starting to see some signs of the supply chain easing. And then there's talk about a new COVID variant that is going around, but COVID as well has kind of dwindled from its importance on the markets and has basically disappeared from having an impact on the markets currently. Within the public markets, as I mentioned, we had very weak returns from public equities and public fixed income, pretty much the lowest returns that we've seen over the last 2 years in a quarter. Private markets outperformed significantly. US value was the best equity asset class, and we had a significant move within the 10-year treasury yield as rates rose by 80 basis points over the quarter. So going into the asset classes a little more detail, we look at how private markets outperform public markets during the first quarter. And again, as I mentioned earlier, this was adding on top of the strong outperformance that these asset classes had relative to public markets in 2021. If we look on the left and look at some of the main benchmarks for public bonds and public equities, those are down anywhere from, let's call it 5.5% to 6%. On the flip side, we look at the three bars on the top right, all the core semi-liquid, high quality private market asset classes all posted positive returns. Private equity able to eke out a little bit of a positive return. Private credit, strong, was able to avoid kind of a lot of the drawdowns that public fixed income had from higher interest rates. And private real assets continues to be our strongest asset class in the portfolio. It continues to benefit from persistent higher inflation and higher replacement costs due to the supply chain constraints. So it was the best performer in 2021, as I mentioned, and it continues to be the best performer here in 2022.
I'll piggyback off of what Nick just said here. But one of the key trends that we've been seeing this year, which is a continuation of a trend since the bottom during the COVID crisis, is the rebound in rates. So we'll take a look here at the 10-year treasury and its longer-term downtrend over the last 20 years. You can see the bottom on the right-hand side of the chart where the 10-year came all the way down to 54 basis points on March 9th of 2020. Since then, we saw it accelerate 93 basis points at the end of the year as vaccines were rolled out and the recovery began in earnest. Cyclical reopening and reflation trades took the lead as risks of deflation and the pessimistic growth backdrop were reversed. During the year of 2021, that's when we accelerated the move to the semi-liquid private markets, like Nick said. This was with a focus on generating interest rate hedged income that could withstand a rising rate environment and inflation surprise, and that actually proved to be pretty prescient in 2022. So far this year, we saw the 10-year treasury rise about 80 basis points. Looking as of the close yesterday, the 10-year closed at 2.7%, which is around 1.2% higher than at the end of the year. So that's a pretty big jump. It's about a 76% increase in rates year to date. So that drove much of the fixed income underperformance that Nick spoke about on the previous slide. So in light of this backdrop, systematic risks have risen alongside high inflation and fallout due to some of the concerns Nick mentioned, geopolitical risks due to global growth, fallout from the Russian invasion of Ukraine and energy prices. These issues combined with potential head fakes from the Fed and their policy and balance sheet normalization may shake weary market participants into de-risking. So we've decided to implement a structural partial hedge on that systematic risk within public equities. We're utilizing these innovator defined outcome ETFs, which provide a corridor of investment returns that investment returns will fall into on a one-year forward basis. So we have one product for each of the key public equity asset classes, and they provide an initial downside protection of 15%. As an example, if the market price levels 1 year from now were down 20%, you'd be made whole on 15% of it, and your net performance would be down 5% gross of fees. In order to provide this protection on the downside, we trade the upside of the investment away above a cap rate. So if the price of the Russell 2000 small cap index in the center of the page is up 14.6% or less for the year, you get the entire return of that index gross of fees. However, if the index performs better than 14.6%, you get no additional upside. So we'd also like to point out that the upside caps are significantly higher than our expected returns for those asset classes, which range from 4.8% for US large cap to 7.2% for emerging markets. We feel that this is a good trade-off as it allows us to participate in the market upside, but gives us some meaningful downside protection for surprises and implications that could sideswipe markets that are already stretched on the basis of valuation. I would also mention that these strategies are fully liquid and exchange traded intraday, just like any other ETF in the portfolio. So we have the ability to put on and take off those exposures as needed.
Now we're going to shift focus to look at the global outlook. So as customary every quarter, we provide an update on our forward-looking capital market returns. Quarter over quarter, there have been small changes to the asset classes. The largest changes have been a move higher in core muni bonds. As interest rates continue to rise, these expected returns should move higher. In equities, US large cap had a small move lower, but nothing significant. And as Matt mentioned, if we compare the expected returns here for the equities in blue relative to the cap rates that we can get from the innovator ETFs, there's significant room above these expected returns in the cap rates. We can participate up to a very high level and possibly not give up any upside return. Private markets still offer attractive relative returns, again, while providing higher interest rate protection and persistent inflation participation, which we saw in the returns. Most public asset classes' expected returns are still significantly lower than the return investors have experienced over the last 20 years. You can see that when you compare the blue circles on the page to where the bar charts are. The one exception is international developed, where the expected return is roughly similar to what we've experienced over the last 20 years. Another familiar chart is our US equity risk premium model. This is the most important asset allocation decision in the public markets and drives our positioning between public fixed income and equities. The signal has been very effective over the long term, especially at extremes. And the signal captures changes in interest rates as well as future expected returns for equities. So this rise in interest rates that Matt mentioned, the bond index we're using on this chart for this analysis is the 10-year Treasury. It's already up 80 basis points for the quarter. It's up another 40 basis points year to date. So those changes get instantly reflected into our model. As mentioned earlier, the current signal is neutral. So that's why a client that's, let's say, is 70% equity, 30% bonds, will find their allocation when we have our meetings here reviewing the first quarter will be very similar to that 70% equity, 30% bonds. So whatever your customized allocation is, your allocation should be roughly in line with that. Looking just at equity market valuations, we focus on US large cap and non-US developed markets for this quarter's chart. We compare 5 important valuation metrics, and the results are consistent across the board. US large cap stocks are expensive relative to their 25-year trailing valuations. So if you compare the second column to the third column there, and they're also expensive when you compare them to the current metrics for non-US developed markets. So the MSCI EFA, which is the third column there on the right. To highlight 2 of the metrics, if we look at that first line item, forward price to earnings ratio, the non-US market, if you compare its 13.7 versus the S&P's 19.5, is currently priced at a 31% discount to US markets. This is greater than a 2 standard deviation signal and is pretty compelling. Also, if we could just look at dividend yields, this also favors non-US investors, as you can earn 2.5% in dividend yield from the non-US markets versus only 1.5% from the US market. So, a good portion of the expected return we're getting from that asset class is coming from dividend yield, which you can, pretty much count on in those investments.
So most of the questions that we received from clients this quarter were regarding inflation and the impact it'll have on interest rates and the probability of recession. So we've actually decided to dedicate an entire section today towards answering some of these questions. So on the first slide here, we have an interesting chart which shows the average container costs across various transportation modalities, including sea, air, and trucking. So one of the key drivers of inflation that was apparent in 2021 was supply chain constraints, which drove cost push inflation. So more recently, we're starting to see signs that these costs have started trending downward since their peak. Although they're still elevated relative to history, more capabilities are being brought online to ease supply chain constraints, which could have an easing effect on at least the supply side inflation expectations. On the next slide, look at a little bit of a different view here. We see that household debt service ratios have been improving since the global financial crisis and have actually declined since COVID, as both the impact of fiscal stimulus and debt forgiveness is reflected in consumer balance sheets. I'll pair this with the next slide, where we see sort of a parallel in corporate America with non-financial corporate debt as a percentage of corporate market value. So this ratio, which gives us a sense of non-financial leverage in the market, this combined with the previous slide, these two data points are actually an indication that systematic financial stress is relatively low, as slowdowns in economic growth and corporate earnings won't be as exacerbated by leverage effects and bankruptcies on the consumer side. So, really, as far as a litmus test for risk, these both indicate that we're less likely to have a catastrophic drawdown like we may have seen during the GFC. On the next portion here, this is sort of the flip side of the consumer, so that with better financial health, it allows them to evaluate decisions more freely. And as we see on this slide here, non-farm job openings are significantly higher than in previous years. They're much slower to fill as part of what we see on the next slide, which is looking at wages. So salaries have increased and wage inflation has spiked to levels higher than we've seen over the last 20 years, particularly in low-skilled jobs, where many of the openings we talked about previously are currently at this point. This particular indicator is fairly meaningful when we think of inflation persistence, as more dollars chase a fixed number of capital goods in aggregate. That, combined with 12% higher tax refunds this year compared to last year, increasing average flight throughput, hotel occupancy is rising, revenues for restaurant bookings, things of that nature. These are all sort of trending positive. So we actually see that the economy isn't quite ready to slow down just yet. So this kind of gives us a little bit of a quandary for the Fed. So this could potentially push the Fed to be slightly more hawkish until the economy starts to show signs of slowing down. So that could not only impact rates, but also wealth effects. So higher rates feed not only through discount rates for bonds and equities, but also impact housing prices due to mortgage rates and the link there. So we actually look at that a little bit deeper on the next slide. So this is us taking a look at the recent surge in mortgage rates. So this chart actually tells us the additional amount of interest rate a mortgage requires above that of the US Treasury 30 years out. The mortgage rates recently have spiked up to between 5.25% to 6.5%, depending on your credit quality of the borrower. So we can see that this hike in mortgage rates hasn't been met with a consummate rise in the 30-year Treasury. So this is pretty anomalous. We haven't seen this occur since the early 80s. But these higher mortgage prices will eventually feed through to home prices, which are extremely elevated across the country and are one of the main drivers of the financial stability of households in the belly of the income distribution. So this essentially tells us that the Fed has to play a little bit of a dangerous balancing game to not start a cascading scenario of raising rates too quickly, which can hurt risk asset prices while driving up the cost to borrow, which drives down demand for housing, causing the prices to plummet, which causes families to tighten up and spend less. So this cyclical cascading effect could be something very risky. So the Fed definitely has to tread lightly. So all of these things really, in a nutshell, support our decision to hedge against not only interest rate risk and focus on high quality private markets, but implement that strategic partial hedge against the systematic risk of risk assets like equities in light of the potential risk of a Fed hard landing.
So we mentioned, the Federal Reserve and their actions is really the focus of a lot of market participants today. The Federal Reserve, we say did a great job to help support the economy coming out of COVID. And what is being considered kind of QE4, the Fed more than doubled its balance sheet. So a lot of, you get a lot of criticism too that maybe the Fed did too much. They added about 4.7 trillion during this last round of quantitative easing. And that raised the balance sheet, as you can see on the chart, to over 9 trillion. Now, as we mentioned, the Fed continues to try to fight inflation. The estimate is that the Fed will shrink its balance sheet, so this 9 trillion, by about $100 billion per month in the near term. The big unknown, as Matt just kind of touched, is whether the Fed can impact inflation, stabilize prices without triggering a market sell-off. This chart here looks at market expectations for the federal funds rate going forward, US. The Fed raised rates for the first time here in March by 25 basis points and is expected to continue raising the Fed funds rate as each subsequent meeting going forward. The expectation is that the Fed might have to be more hawkish going forward and that the next hikes could be as high as 50 basis points each time. That level of 50 basis points for a hike has not been seen since the year 2000. So it's been over 20 years since we've had a hike that high. So that'll be interesting to see how the market handles that. Matt just described many data points that point to the economy still showing some strong fundamentals. Fed Reserve Chair Powell recently stated something similar. He said all signs are that this is a strong economy, indeed one that will be able to flourish in the face of less accommodative monetary policy. Not that we'd expect him to say that the Fed moves are going to cause a big disruption, but I think we're somewhat in line to that statement as we see a lot of strong data points in the economy. In summary, when we look at our portfolio and our allocation, I think we've gone through and identified the 4 market headwinds, rising interest rates, federal policy shift, persistent inflation, and geopolitical uncertainty. So what we've done over the last 15, 18 months is we've shifted our positioning. We really want to create this concept of an all-weather portfolio that has aspects to it that should perform well in all different market environments. So we've shifted portfolios to shorter duration. We've gotten rid of some of the kind of corporate interest rate sensitive bonds by investing in floating rate bonds. We made our shift to private markets and credit, equity, and real assets. We're going to look to continue to add to those asset classes over the rest of 2022. And as Matt just mentioned as well, the defined outcome ETFs. We think these are a great new toolbox that will enable us to still participate in equity markets, but having some comfort that should there be a drawdown in public markets, we'll be protected from that somewhat over the next 12 months.
So to kind of finish up, I want to talk about a little firm and investment strategy update. We're now at 45 kind of dedicated client relationships with the firm. We now manage directly 1.1 billion in assets under management. We say those are assets under our direct control and advisement. There's obviously a lot of other assets for clients that we're monitoring or reporting on. So we're really excited about the continued growth of the firm. We are now in the process of talking to candidates to join us in our operations department to work directly with Dan Chesson. And many of you offer to serve as kind of beta testers for our new portal that's run by a firm called Orion. So over the next 4 to 6 weeks, we'll be contacting each of you to set up your own kind of demonstration and tutorial. Matt will be working with you on that. So that's an exciting new technology development at the firm. So that's really started back in last June. So it's taken us quite a while to have that fully integrated. And then our new website, kind of in collaboration with Orion, will be launched here probably at the end of this month or sometime in early May. So those are all positive trends at the firm. And once again, the next things that we're looking at from a strategy perspective that Nick and Matt are leading, we are in final steps of kind of considering what we call a credit dislocation fund. We referenced this in our last webcast, and I know I've talked to all of you about that in meetings. So we're going to be voting on a candidate in that specific class. We're also looking at a venture capital focused fund. A couple of the firms that we've had a lot of interest have not been on market, and will be coming back to market this calendar year. So we're now getting ready for them to launch their next vehicles. So we're doing due diligence on those. And then finally, to fill out and have one more real asset investment fund. And Nick and I were actually part of several meetings with, we think, a very strong candidate that also is coming to market soon with a portfolio. So we fully expect that we'll have all 3 of these as part of the diversified structures by the end of this calendar year, and probably one of them a little bit sooner. So that's kind of our final update. We appreciate the trust and confidence in our organization. So we're going to be, if we've not had your final review, we'll be in touch with you real soon to schedule that. And we want to wish all of you a great spring and have a wonderful weekend. Thanks so much for your time today.